What if you had the worst financial luck in history? What if every single time you decided to invest your hard-earned money, it was the absolute worst moment possible? Not just a bad moment, but the exact peak of the market right before a painful, gut-wrenching crash. We all have this fear, don't we? It's the number one thing that keeps people from building wealth. It's that voice in the back of your head that says, what if I'm buying the top? What if I invest today and the market collapses tomorrow? This fear is paralyzing. It's the reason millions of people are sitting on the sidelines, their savings in cash, while inflation silently eats away at their purchasing power year after year. They're waiting for the perfect time to get in, waiting for the bottom of the next dip. But what if that entire mindset is completely wrong? What if I told you that investing at the worst possible time consistently for decades would still have made you incredibly, unbelievably wealthy? Today, we are going to look at the hard, cold data. We're going to run a simulation based on 70 years of market history to answer this exact question. We'll follow an investor with perfectly bad luck, and as the title of this video promises, the math will surprise you. By the end of this, you will no longer fear a market crash. You will fear being left behind. To run this experiment, we first needed to define our investor. We'll call him Unlucky Pete. And to make this simulation as realistic as possible, we need to set some clear ground rules. We are going to use one of the largest and most reliable datasets in the world, 70 years of S&P 500 data from January 1955 all the way to December 2024. This period covers everything: the 1970s stagflation, the 1987 Black Monday crash, the 2000 dot-com bubble, the 2008 global financial crisis, and the 2020 pandemic drop. There is no cherry picking here. Now, let's establish the rules for our Unlucky Pete. Rule number 1, the contribution. Our investor started by saving $100 per month back in 1955. But to make this fair, we can't keep it at $100 for 70 years. We have to index that contribution to inflation. So as prices rise, his savings rate rises too. That $100 a month in 1955 grew to about $1,200 per month by 2024. This is a realistic, disciplined savings plan. Over the 70-year period, he saved a total of approximately $420,000. Rule number 2, the waiting strategy. This is where it gets interesting. Our investor is paralyzed by fear. He doesn't just invest his money every month. No, he thinks that's too risky. Instead, he takes his monthly savings and puts it into a safe, standard deposit account, earning a little bit of interest. He holds his cash and he waits. He's waiting for a sign. Rule number 3, the perfectly unlucky timing. This is the most important rule. The only time our Unlucky Pete gets the courage to move his money from his safe deposit account into the stock market is immediately before a major market decline of 15% or more. Think about that. He doesn't buy after the top, he buys right on the top. He accumulates a big pile of cash, and the very moment he decides to finally pull the trigger and invest it all, bam! The market collapses. He feels the full, immediate, sickening pain of the drop. Imagine saving up cash for months, finally investing it in September 2008, only to see the entire global financial system implode the next day. Imagine investing your pandemic savings in February 2020. This is what our investor does every single time. He has the worst timing in human history. This is the perfectly unlucky timing strategy. So, what's the outcome? What is the final price of this catastrophic luck? Before we reveal the final number, we need a baseline for comparison. After all, $420,000 in contributions is a lot of money. What if our investor had just followed the safest advice? What if he'd just kept all his money in that deposit account? He saves his $100 and rising every month, and he never invests it. He just lets it sit in a high-yield savings account earning historical U.S. interest rates for 70 years. He avoids all the crashes, all the volatility, all the stress. He plays it perfectly safe. What happens? His $420,000 in total contributions grew to $1.25 million. Now that's not bad. He's a millionaire. He's multiplied his money by 3. This seems like a pretty decent outcome for taking on zero risk, right? This is the safe choice. Now, let's look at our unlucky Pete. He endured every crash. He felt the pain of the dot-com bubble bursting, of Lehman Brothers collapsing. He bought the top again and again and again. He made the worst possible mistake repeatedly for his entire life. So, what did his $420,000 in contributions grow to? Are you ready for this? $17.7 million. Let's say that again. The safe investor who avoided all risk ended up with $1.25 million. Unlucky Pete, who had the worst timing in history, ended up with $17.7 million. That is not a typo. That is the mathematical reality. Investing with perfectly bad timing was 14 times better than not investing at all. This is the first major surprise from the data. The lesson is powerful and undeniable. The real risk isn't being in the market at the wrong time. The real risk is not being in the market at all. The person who played it safe lost out on over $16 million in potential wealth. Their fear, their paralysis, cost them 14 times their final outcome. When you see a chart of this, it's almost comical. On one side, you have the tiny bar of the deposit account. On the other hand, you have the skyscraper of Unlucky Pete's portfolio. The worst-case scenario for an investor was astronomically better than the best-case scenario for a saver. Now, a smart skeptic watching this might say, okay, I get it. Investing is better than cash, but $17.7 million is still the unlucky number. What would a normal investor have made? This is the right question to ask. We need a second baseline. Let's introduce a new investor. We'll call him Disciplined Dave. He follows a simple, boring strategy called dollar cost averaging, or DCA. He doesn't read the headlines, he doesn't check his portfolio every day, he doesn't try to time the market. He simply buys his $100 and rising every single day on the same day, no matter what. Whether the market is up, down, or sideways, he just buys. He bought through the 70s, he bought through the 90s, he bought in 2008, and he bought in 2020. He is a robot. He also contributes the exact same $420,000 over 70 years. So what is his final result? The boring, disciplined Dave ended up with $23.1 million. Now we have the complete picture. The safe Tom, $1.25 million. Unlucky Pete, $17.7 million. Disciplined Dave, $23.1 million. This is where we find the true cost of bad timing. The boring DCA strategy was in fact the best. Our Unlucky Pete's penalty for his terrible lick was the difference between $23.1 million and $17.7 million. That's a difference of $5.4 million, or about 23% of the final value. So let's be clear, bad timing does have a cost. Trying to time the market and failing at it will leave you with less than a simple automated strategy. A 23% penalty is not nothing. But let's reframe this. This is the most important part. Pete's penalty was $5.4 million, but his reward for simply being in the market, even at the worst times, was over $16 million compared to the person who stayed in cash. The entire conversation about market timing is happening in the wrong place. We're all terrified of that 23% timing penalty, so we sit in cash and get hit with a 94% paralysis penalty. Unlucky Pete's only skill was that he eventually did invest his money. He didn't panic sell, he just bought at the wrong time, held on, and let time and compound growth do the rest. And for that, he was rewarded with generational wealth. The S&P 500 has been one of the best performing indexes in world history. Is this 70-year data just a lucky fluke of America-only growth? What happens if we run this same test on a global scale? For this, we'll use the MSCI World Index. This dataset is a bit shorter, starting in 1970, so we're looking at 55 years of data. This index includes companies from all over the world: Europe, Japan, Australia, and North America. The total contributions over these 55 years were approximately $280,000 for all our strategies. Let's see the results. First, the boring DCA Global. Our Disciplined Dave ended up with $4.8 million, a solid 17 times multiplier. Now, the unlucky Pete Global, our guy who once again only invested his cash right before every global market crash of 15% or more. His $280,000 grew to $3.3 million. The principle holds exactly the same. In fact, the timing penalty on the global stage was even larger. Unlucky Pete underperformed Disciplined Dave by 31%. This makes sense. Global markets are more volatile and have had longer periods of stagnation than the U.S. market. But even with a 31% penalty, the unlucky global investors still multiplied their money 12-fold.
They failed their way to $3.3 million, while Disciplined Dave got $4.8 million. And the person who stayed in cash, they ended up with just a fraction of that. The data is crystal clear, whether in the US or globally. Unlucky Pete's outcome is always in a completely different universe from the person who stays in a deposit account. So far, we've only focused on Unlucky Pete. We have proven beyond a shadow of a doubt that investing before a crash is 1,000,000 times better than not investing at all. But this brings us to the other side of market timing. It's the other great fear that paralyzes investors. It's the fear of buying the top. This is the person who looks at the market today and says, it's at an all-time high, it can't go any higher, it must be a bubble, I'm going to wait for a pullback. This feels smart, it feels prudent, it feels safe. But what if this too is a massive multi-million-dollar mistake? Let's run one final simulation. Let's create a new investor, the all-time high George. He is only brave enough to invest his money when the market is hitting a new record. His rules? He saves his $100 and rising in his deposit account. He only invests his accumulated cash in months when the S&P 500 is at a brand new all-time high. This strategy feels like the most dangerous, reckless, and foolish strategy imaginable. You are literally only buying at the absolute peak of the market. You are guaranteeing that you never ever buy a dip. So let's go back to our 70-year S&P 500 dataset. We know Disciplined Dave got $23.1 million. What does our all-time high investor get? What is the price for this seemingly idiotic strategy? His $420,000 in contributions grows to $22 million. Let's just pause and absorb that. Disciplined Dave, $23.1 million. The all-time high George, $22 million. The difference is nothing. It's a rounding error. The penalty for investing only at record-breaking market peaks was a mere 4 to 5% over 70 years. This is the second and perhaps even bigger surprise from the math. The fear of buying the top is statistically baseless. It is a ghost. It is a phantom. Why? Because markets go up. That's what they do over the long term. Hitting all-time highs is not a warning sign. It's a sign of a healthy, functioning, growing market. The market spends a lot of its time at or near all-time highs. By waiting for a dip, you are more often than not just missing out on more gains. The all-time high investor and Disciplined Dave ended up in the exact same place as multi-millionaires. So what have we learned today? What does math really tell us? We've proven two fundamental truths. Truth number one, investing with the worst possible timing imaginable, that is, only investing right before every major market crash, is still massively, incredibly, life-changingly better than not investing at all. Unlucky Pete ended up with $17.7 million, while the safe saver ended up with just $1.25 million. Truth number two, investing with what feels like the most reckless timing, that is, only investing at all-time market peaks, gives you virtually the exact same result as a disciplined DCA strategy. The $22 million for the peak buyer versus $23.1 million for Disciplined Dave is a rounding error. So what is the final message? The data is conclusive. The market's timing is a distraction. It's noise. It's a story we tell ourselves to justify our fear. The fear of bad timing is infinitely more costly than the bad timing itself. The math is clear. The true worst-case scenario isn't investing before a crash. The true worst-case scenario is looking back 50 years from now, having waited on the sidelines in a safe deposit account, paralyzed by a fear of the top, only to realize the market created generational wealth without you.